Hi, this is a screencast for the California Pizza Kitchen. We're going to go over just look quickly at the two spreadsheets that I think need some explanation. Again, it's easier to see this way on your own device than it would be to stare up at to try to figure it out on the screen while I hop around in class. But I'm going to hop around here anyway because I only have 15 minutes. Meanwhile, this is the exhibit that's in the textbook, Exhibit 9, that is a very simplified pro forma tax shield effect of the recapitalization. Remember, we saw that when a company borrows money, since the taxes that would otherwise be paid are reduced, that's referred to as a tax shield. That money flows to the shareholders. Can't go to the creditors because the creditors really don't participate in any value except in liquidation, and they only participate up to the value of their debt. In other words, if you're a bank and you have a $10 million loan, that's all you get back plus the interest you're owed. Anyway, back to this. We look at what was actually the case in 2007, and these are scenarios for the debt to capital ratio, where they're either going to say we're going to raise 10% of the capital in debt, they're going to raise 20 or 30%. And I'll look quickly at the 10% scenario. 10% of the book capital, book equity, is where book equity and equity is total capital because there is no debt, is $225,888,000. It means they will go out and borrow $22,589,000 from the bank. And the effect of that would be that the new capital, remember, these funds that borrowed from the bank are not going in the business to increase assets. It is simply, it's not making the company bigger. It's simply going back to the shareholders. The shareholders get this cash, and now the equity, which is assets which didn't change, minus liabilities, which increased $22,509,000, is going to be equal to an equity of $203,299, which brings us back to where it was, where it would be otherwise with no debt. It's just the total capital doesn't change. It's just that there's a substitution of debt for equity throughout on the book basis. So that's pretty straightforward. On the market basis, though, is we define the market value of equity. It's equal to the price of $22.10 a share. I'll put this here, and there's also way down here you can read this, times 2,130,000 shares. What happens here to equity, you can see from this equation, is they look at the previous, under the original scenario, how much is equity going to change? Well, it's going to be the previous equity plus the debt tax shield is added. So the money that this is the value that is reclaimed from the IRS. That is the debt times the tax rate. So this is that perpetual one-time adjustment. And they're subtracting from that the debt because, again, the business is not owned entirely by the shareholders. The business is not funded by the shareholders. There are claims by the creditors. Remember, when we talk about enterprise value, we see value of the business minus value of the debt is value of what the shareholders have. So it goes down by this amount, by the $22,589,000, just as it does on a book basis, but on a market basis, because market looks at the future value, and the future value of the debt tax shield is, and if you can read up to this this equation up here, I'm going to pour that over it. You can see it right away. It is the previous market value plus this D25 times D11, that's the tax rate, times the amount of debt. That's the benefit of the debt tax shield. And the, I guess you should call it interest tax shield. It sort of goes either way, as I mentioned in class, times the amount of debt. And so as more debt is added, equity starts to go down, but again, they recover a little bit of that from the tax effect. So let's look at this other exhibit that we had that got a little more complicated. We're going to look at some broader effects after that. Again, that one was in the book. The debt is expected to be borrowed based on their credit line from Bank of America at 11.16%. So, and the tax rate's not supposed to change. These are the three scenarios. Their earnings before interest and taxes was $30,054,000. Since there is no interest, since there is no debt, that's also their earnings before taxes. They pay taxes at a rate of 32.5%, and net income is $20,299,000. The book value, as we saw above, no debt, equity of $225 million. That doesn't change. Total capital, so we saw that on the last slide. And return on equity, which is measured as net income over equity, you can see that, is 9%. Adding debt, there is initially interest expense incurred. So if you see, net income drops from $20,299,000 to $19,359,000. And debt is now in the part of the capitalization, just like we saw in 9. And so, because this version simply adds the effects of interest expense and calculates some of the returns and the other important changes in the business. And since there is a smaller amount of equity that is that the income is being divided into, then the ROI goes up, return on equity goes up. However, income does get smaller because of interest expense, and that happens throughout. So the more debt they raise, or the money they borrow from the bank, the higher the interest expense. Remember, they're borrowing 30%, so 30% means they're borrowing $67,766,000. That's 30% of this 225, and that has an interest expense of $4 million. It reduces net income from the original $20,299,000 down to $17,480,000, but it also serves to reduce book equity to $158. So that number divided by that number is 11.1%. So you can see that there is a higher return on equity. Again, it's all about leverage, like we talk about the house. We can't ignore the fact that money costs money. That was awful. Anyway, let's look at what it does on a market value basis. On a market value basis, the market value of debt divided by market value of capital doesn't change very much because there's not a lot of debt raised given the large market capitalization, or the relatively large market to book ratio, I should say. So market value of debt to market value of capital gets up to 10% when debt to capital on a book basis goes all the way up to 30%. It just shows a healthy market to book ratio. But what happens to the share price? And this is the interesting one. At $22.10 a share, the original, by going out and borrowing this amount, again, the $22,589,000, the stock price goes up. Why is that the case? Well, once again, the value of the tax shield remains with the shareholders. So the expression for that is the previous, not the previous years, but the existing stock price will be improved by the debt. I'm showing you this. The amount of debt raised times the tax rate, and they divide it by this C34, which is the number of shares outstanding, because it's on a per share basis. So this is $22.10 a share, and we're adding 25 cents a share, which is 32.5% times 22,589,000 and divided by number of shares outstanding. So again, this adjustment of the debt times the tax rate raises the stock price. So the more debt, the higher the stock price goes, because the value that is not paid away to the tax authorities. Now, in this case, they're repurchasing shares with the funds. That when they have $22,589, they're capable, 22 million, I'm sorry, 589,000 in new debt. They're capable of buying at this new price, 22.35. They're capable of buying back 1,011,000 shares. And it goes up. The more debt they borrow, the more shares they can repurchase. So this reduces the number of shares outstanding. And as a result of reducing the earnings per share, because while the earnings go down, remember, because they borrow money lowers earnings, number of shares go down. So the EPS effect is dragged down, and while shares are reduced, lowering the denominator, the lower earnings, in effect, tends to lower the earnings per share because of the interest, and so on. What happens to the price to earnings ratio? This tends to go up because the share price increases. And again, this is all just ratios. These are all just math. That divided by that, that divided by that. So price to earnings ratio actually improves because stock price goes up at a faster rate than earnings per share go down thanks to the interest. Finally, relative to cost of capital, we saw what happens to beta. When more money is borrowed because of this levered beta formula, the beta goes from 0.85 to 0.87. Again, this ratio, these calculations correspond to this ratio, where it is unlevered beta, this is the BU here in blue, times 1 plus 1 minus the tax rate. Sorry, got to get back over here. Times 1 minus the tax rate, 1 plus 1 minus the tax rate, times the new debt to equity ratio. And they're using market, of course. So here's the debt to equity ratio, 22,589,000 over 628,516. So we add leverage, we adjust it for the tax benefit, and this solves for the new levered beta. And as more leverage, more debt comes to the balance sheet, then the higher the beta. This raises cost of equity. We have the risk-free rate times the market risk premium times the beta as such. And the weighted average cost of capital, however, goes down. And the reason for that, again, is that, remember, debt is costing them 16%, equity costs, 6.6%, equity costs them 9.5%. And so if you're substituting capital that costs 6.16% before taxes, it's going to cost even less after taxes, of course, for a source of capital that costs 9.5%, then the total weighted average cost of capital should go down. You're using a smaller amount of equity, but what's happening, though, is the equity is getting more expensive. Cost of equity is going up. Weighted average cost of capital is going down throughout this, and there is a point where it starts to turn back around. Anyway, that's the explanation. I hope it isn't too clumsy.